Lenders are taking on more risk in order to capture volume in a tight originations environment. What kind of risks are being taken that weren't being taken just a few years ago? To answer that question and more, Burton Embry, EVP and Chief Compliance Officer of Primary Residential Mortgage, is back with us again to talk about those issues.
You're listening to The Compliance Insiders with Roger Fendelman, where you can hear the best and brightest experts in the mortgage industry discuss compliance and technology issues that affect you. It's all you need to know in 10 minutes or less.
Burt, thanks so much again for joining us.
Good morning, Roger. Thanks for having me on, and thanks for picking up these podcasts again. We all enjoyed listening to them and learned quite a bit from all of the people that you've had on, so thanks a lot. Lenders are in a precarious position these days because we're all facing lower volumes, we're facing thinner margins, and it's a tough time to be a lender. And of course, the Fed isn't helping us out by raising interest rates and what have you. So the industry has changed quite a bit since you and I have last spoken. Roger, before I answer your question, let me just give a quick disclaimer that these are my thoughts and opinions and not necessarily those of Primary Residential Mortgage, its directors or officers or employees. But you know how I am. I just get going sometimes. We're seeing a lot of lenders take on more risk because they're chasing lower loan volumes. There's just not as many home buyers in the market. And when the pool shrinks, it seems to be natural in our industry anyway that we do a number of different things to try to capture more volume. And in our particular case, we see lenders across the country just taking on more risk. And from a compliance person and a risk person standpoint, there's not necessarily problems taking on more risk, depending on what that risk is, by the way. I need to add that. But if you're going to take on more risk, you've got to see the corresponding reward for taking that on. Otherwise, taking on more risk just to take on more risk isn't a good recipe for success. It's kind of like a boat that's in a storm taking on more water and nobody's taking water off. Sooner or later, that boat's going to sink. So if you're going to take on more risk, the next question is, well, what's my reward? And we're seeing a lot of lenders take on more risks these days.
Burt, what types of risks are we seeing out there?
The primary area of additional risk that we're seeing is around the LO comp rule. And of course, as you can imagine, that's the rule that affects loan officers more because it messes with their pocketbook. So we're seeing people who are doing things today that 6 months ago or a year ago, they just simply weren't doing. For example, we're seeing companies who have decided that they're going to start paying differently on these state housing loans or these bond loans, as they're called. But those were not exempt from the LO comp rule and today are not exempt from the LO comp rule. And yet some lenders have made a decision that they're going to pay differently on those than they do their other loans, merely because they make less money on those loans. So they've kind of said, well, we're going to just forget the LO comp prohibition on this and all of the communications that the CFPB has provided to lenders regarding not paying differently on these loans, and we're going to pay differently. And if we get challenged on it, our defense is going to be, well, it's in the best interest of the consumer. It allows us to offer these loans, yada, yada, yada. And I'm not so sure that that's a great position to take. But as my company recruits loan officers from others, we are hearing that that's one area where lenders have made a distinct change from where they were at 6 or 12 months ago.
Well, that's a dangerous game to be in. We all understand the need to remain profitable in this down environment and the challenges faced. And I have a feeling some people out there are weighing their compliance risk, whether or not regulators will react harshly or give them a free pass or somewhere in between. And others might just be thumbing their nose at it. So not really something I'd recommend. I don't know about you.
Well, again, sticking with the LO comp rule for just a minute, Roger, we're seeing some entities who are paying differently FHA or VA loans. And I'm sure the argument there is going to be that, FHA loans take more time to originate and process than does a conventional loan. I just hope if you get challenged on that you can prove it.
Yeah.
To just merely say, oh, they take more time and not have any time studies or anything, I think is opening you up to a lot of potential exposure down the road. And I think some of these lenders have just taken the position that they're going to try to do what's best for the consumer, which is certainly nothing wrong with that, even if it flies in face of TRID or LO Comp or whatever. And that's going to be the defense. And while that might work, and I emphasize might work for a regulator, I don't know that works in a court. Last I knew anyway, judges had to base their decisions and verdicts on what the law says, not a feel-good story from a lender. There's just a lot of risks out there today that we just didn't see months ago.
You're 100% right. And I don't think I would want to be in a position to have to defend myself, like you said, unless you have definitive proof that there is a tremendous difference in, for example, the amount of work and effort going into processing a govie versus a conventional loan. I think you're going to be fighting against a lot of forces, including if you have a disproportionately large number of government loans that you're originating, and that might be due to steering, where the LOs are steering their customers unnecessarily, perhaps, to FHA lending. That's not good. That doesn't fly, and that gets regulators' attention. Those are some real challenges. Again, it's each lender's risk appetite here in determining what's the right way to go, but you are taking on a fairly large amount of risk by doing that.
Right. And again, if you're going to take on risk, you better have the reward. And oh, by the way, as you and I are recording this, Roger, there's been 1 or 2 False Claims Act case settlements out there as well for 8 figures being 10 million plus. I don't know. If you're going to throw caution into the wind, you better be very, very careful with it.
I agree. Burt, thanks so much for being back. Want to have you on again.
Are you a compliance insider? Then go to compliancepodcast.com immediately and join our mailing list so you never miss an episode. Got something to say? Request to be on the show. Go to compliancepodcast.com with your topic ideas. And as always, thank you for listening.